Zan, the real question is exactly how deep is that economic shock going to be in Q1 and then extending on to Q2 as well. When you look at the historical precedent here, going back to the SARS crisis, US equity markets didn't actually find a floor until 1 week after new infections peaked. So when you look at the situation in the United States right now, do you think that we are ahead of the infection curve, or is this going to get worse before it gets any better?
Well, I think from a virus perspective, at least in the United States and many other Western democracies, I think it gets worse before it gets better. And I think we have to sort of end the comps to SARS. Not only now are the comps in terms of virus incidence and the death rate quite different, but the nature of where we are in the economic cycle, the fact that we've got other hits happening now too, with the carnage in the credit markets, largely exacerbated by the OPEC price war and the crash in oil prices. It's a bit of a vicious storm here, and I've been in the business 34 years, and it's kind of a monster mashup of 1987 to some degree, 2001, 9/11, with just the fear and uncertainty that this engenders. And then in terms of the infection into the financial system, not just driven by the virus, but the aforementioned problems in the credit markets, it's got a little bit of a look of 2008 too. So there really aren't many historic comps. And then I think in terms of second quarter economic data, we're going to see Great Depression era numbers. The potential, other side of that is that, let's all knock wood, say bad rice, whatever you want to do, that this is not a long-lived contraction in the economy akin to the 1930s, but it's going to be, at least for the second quarter, more severe than even what we saw then.
Liz, one of the other senses that I'm getting from industry out there is that everything we thought we knew about the state of the US economy is being challenged right now as well. We have entire industries going hand in hand to the US government, like aviation, asking for help and asking for a bailout. The question is, do you think that investors might have overstated the health of corporate America coming into this?
Well, that had been one of our themes going into this, because in terms of the differential between what the stock market is doing and what the broadest measure of corporate profitability, not just S&P operating earnings per share, but broader U.S. corporate profitability, there was an unprecedented gap that had developed, suggesting that the market was sort of, to use an American expression, out over its skis relative to the underlying profitability of corporations. The problem is now we've swung the valuation pendulum in the complete opposite direction. The rub, though, is that normally when you're in a bear market and you've seen a drop as severe as this, you start to do valuation analysis. Okay, has the market dropped sufficient enough that we're now looking at reasonable valuations or cheap valuations? And on the surface, at a moment in time, you could say yes, at a forward PE of only about 13 times for the S&P 500, the market's pretty cheap. The problem is the denominator, the E, the earnings, are falling as rapidly as the price. And on a forward-looking basis, analysts have no idea what to do with estimates, because many of the companies most hard hit by this, you mentioned aviation, anything travel-related, anything consumer discretionary, many of those companies have simply withdrawn guidance to Wall Street. They're not lowering guidance, they're just withdrawing it. So we're all flying a bit blind here in terms of what to do with estimates, which means valuation analysis is almost irrelevant at this point in time.